Okay, so this last part three of chapter 15 on monetary policy. It's kind of a weird title here because it's an ever-changing story, right? The world has changed to the point where when I went to the Fed conference last time, 2017, the discussion was basically, yeah, some of these parts of textbooks need to be thrown away because the playbook has been rewritten in the Great Recession. But anyway, so how did the book describes as does, more accurately, how did the Federal Reserve influence interest rates? And a little bit on how we do now, although that will not be tested on the final exam, but important to kind of have some to at least mention it. All right. So, what mechanism, how did the Federal Reserve influence interest rates in simpler times, basically before the Great Recession? So we've already talked about this effectively, right? Open market operations. So if the Fed buys and sells treasuries, right, they influence the money supply. So if they want to, for example, increase the money supply, they buy treasuries, which puts more reserves in the banking system, which means they could make more loans, which means the money supply expands, which basically, or if they go in the opposite direction, when they sell treasuries to banks, banks lose reserves. They reduce their loans because they don't have the reserves to make as many loans as before. And the money supply contracts. So this was kind of the mechanism they used to use. Again, they did that by selling treasuries. And this used to as well be how they lowered interest rates. So not only did they change the money supply, but when you change the reserves in the system, right? So this is a money demand, right? Basically short-term money demand, right? So remember the interest rate that, let's say that this is the federal funds rate we got targeted here, right? So remember what the federal funds rate is. The federal funds rate is banks borrowing from each other overnight. Why the hell would banks want to borrow money from each other overnight? Well, in a world where not every bank has as much excess reserves as they want, there might be a time where a bunch of their deposits get called, people take money out, and they get to a point where, hey, they are short on reserves. Well, they have a reserve requirement, right? They need to have at least 10% reserves, as we talked about in chapter 14. So if they don't have that, but some other bank has excess reserves, well, that's what the money, the federal funds rate is for. That's the interest rate at which they would borrow those excess reserves. So if the Federal Reserve wants to lower that interest rate, right, well, they put in more reserves, which is basically, the money supply. So they increase the money supply, or at least the monetary base, put more reserves into the system, which means that there's more supply of money to lend from between banks, and given, assuming there hasn't been a change in the demand, right? So this is the money demand from banks. Well, anytime supply increases, price goes down, and the price of borrowing money is the interest rate. So this is how the Federal Reserve could lower the federal funds rate in a world where there wasn't a silly amount of excess reserves, right? So as that lowers, right, it would then increase aggregate demand by increasing investment, increasing consumption from borrowing. Well, we have a world now where there are a crazy amount of excess reserves, right? Although open market operations directly influence the reserves, when there are a lot of excess reserves, it doesn't really help you lower the federal funds rate, as the previous slide, right, as the picture suggests. Because what does the world look like, right? The Fed is maxed out. The interest rate has already gone to zero, and they kept buying things. They kept putting more reserves out there to achieve other purposes, right? To prop up the value, or not have the value of mortgage-backed securities tank in the Great Recession. As we saw in part two, they're doing similar things with mortgage-backed securities, and all other types of assets now to try to make sure that the value of those financial assets don't just collapse as this coronavirus pandemic created recession, maybe depression, kicks in. So more and more excess reserves exist, right? Well, when we're already at the zero lower bound and they kept putting in excess reserves, banks have plenty of excess reserves, so there's really nowhere to lend them anymore, right? So if you think about the slide we looked at a second ago, well, here was that money demand curve. And as long as we're somewhere along that curve, everything's great. But when there are enough reserves where we're out here somewhere, right, with zero interest rate, and they kept buying more and more reserves, or buying more and more treasuries, so putting more and more reserves in the banking system, so the supply of reserves kept growing. Well, if you buy more reserves, well, you can't lower the interest rate below zero, right? Or, even if you sell reserves and you go the other way, right? You go from this supply 2 to supply 1, that doesn't raise the interest rate. You got to get rid of so much, trillions of dollars, a couple $1 trillion of reserves before you get to this sloped part of the demand curve where you could actually use open market operations to raise the federal funds rate. And you certainly can't, lower it, right, with this. So if, for example, the Federal Reserve wanted to go the other way, so they already got it to zero. So, but if they wanted to raise the federal funds rate, as they were starting to do, right, before the pandemic hit, right, well, they can't just go out and buy. I guess theoretically they could, but it would tank so many markets that they wouldn't just go out and buy very quickly, a couple $1 trillion worth of financial assets to try to raise the federal funds rate. So they've come up with another mechanism, right? So in a world of excess reserves, buying or selling reserves doesn't really change the federal funds rate because you're on this flat part of the demand curve, right, on the zero part. So how do you do it? Well, they've done something basically called, so banks hold these reserves, so let's pay them interest on those reserves. And they call that interest on required reserves, right, the piece that they have to keep, and interest on excess reserves, right? So this amount that they're holding above and beyond what is required to hold for their deposits, right, above their required reserve ratio of 10%. So if they want to raise or lower the federal funds rate these days, as this article and this excerpt from the Fed talks about, well, they change these interest rates, right? So if they wanted to raise, for example, the federal funds rate so God willing, the pandemic situation improves in a couple of years, or maybe even sooner, and they want to start raising the federal funds rate. Well, they're going to have so much excess reserves out there that that's not going to be a very effective method, or an effective method at all, for quite a while, until they shrink their balance sheet and there's less excess reserves in the financial system and banking system. So they could raise this interest rate. Well, why would raising the interest rate raise the federal funds rate? Well, let's think about it. Let's imagine the Federal Reserve said, hey, let's raise the federal funds rate from 0 to 2.4. And we're going to do that by paying banks 2.4% on their excess reserves. Well, if I'm a bank and I'm sitting here collecting 2.4% by holding these excess reserves, and another bank comes to me and say, hey, I don't have enough reserves, I want to borrow some. Well, what interest rate am I going to charge them? Am I going to lend them those excess reserves at a 1% interest rate? Well, no. Why would I do that? Because the Federal Reserve is paying me 2.4. So the bank would have to give me something a little bit more than the 2.4 interest rate that the Federal Reserve is paying me on my excess reserve balances before I lend it. So effectively, whatever the Fed is paying in interest, that creates a lower threshold for the federal funds rate. And if they want that lower threshold to be higher, they pay more in interest. Now, as an aside, when I heard about this for the first time when I was at this Fed conference, I started to get really pretty freaking frustrated, when I think back to the financial crisis, because effectively, what's the story here? So the banking system, right, and investment banks, everybody else, they basically tanked the world financial system. And now, as part of the way to fix it, they're getting paid billions of dollars to hold these excess reserves that the only reason they exist is because they tanked the financial system. Right? Obviously, the banking system didn't create the coronavirus, but the story's still there, right? Paying interest on these excess reserves that were created, it's a way to achieve this outcome. And I asked them this question: "Isn't that true? Isn't that true?" And people didn't seem to think it was as big of a deal, but effectively that is in fact the story. Now, if this was a little confusing, don't worry too much about it. This how they do it now is not part of the final exam. The final exam stops at the traditional story of, this is how, the Federal Reserve raises and lowers the federal funds rate by open market operations, which isn't quite accurate anymore. I think that's all I got. Right? Let me make sure that's all I got before I end this. Yep, and then there's an appendix that I'm not doing this semester, but I don't want to get rid of it. So if I delete it off here, I'm going to forget about it. Anyway, that is the end of the material for this spring semester of 2020. Thank you much.